What's going on, traders? Welcome to the Market Primer for January 24th, 2022. We're starting off with the S&P 500. Last week, we made the case that if we were to see a failed breakdown, there's a tendency for the market to move to the other end of the range, which would be here. So we did see that. And the second point I made last week was that this level had way too many eyeballs on it. So it's such an obvious support level. Either we were going to truncate above it and not see it touched, or we were just going to go through it because those obvious longs are going to have obvious stops underneath that as well. So that did come into play. The speed is something that I certainly didn't expect. I wasn't looking for, back-to-back over 1% sell days. So what levels we have here are very clear on a daily chart right now. We have this internal pivot level and local low volume node coming into play right where price is coming in. You also have the anchored VWAP from March of last year. And so that is basically catching up, and we could see some reinforcement from that indicator as well. If that place doesn't hold, then, there might be something just underneath that as we come into this smaller pivot level right here. But if we were to see continuation like we did over the past two trading days, then that range is not very wide. All right, consider this range that we saw right here, and then this intraday range from Thursday. So it would be unreasonable to expect that as the buy it with both hands level unless you've got something really lined up right there. Underneath that, we do have about 428 half to 425 2/3 into this local LVN, and that is off this support and this support right here. It did go a little bit underneath it, but we're drawing with crayons here. We will also have the prior resistance levels from the local top back in the summer start coming to play right underneath that. So there's some evidence that if we were to see a push underneath that, we would probably see some buyers step up. All right, especially if we were to go through there quickly. Now, I'm not expecting this to be like a 2020 crash. I'm not even expecting it to be like a 2016 crash. Was that the beginning of the taper tantrum? What we could see instead is the introduction of a longer term, kind of more distributive range. And I'm going to go, I know this is going way back, but something along the lines of what we had either 2010 or 2011, where we just get these, here they are, just these grinds and kind of a very, very choppy market. It's most likely that the market is going to introduce some kind of a new range developing, all right? And I know I just skipped through a lot of price action here, so let me just get back to it. So we could see something, and this would be kind of hilarious, right? Where, maybe we do find some support right here, and then we bounce, and maybe we retest the underside of this trend line coupled with maybe an anchored VWAP from this level. I don't have it drawn, but it's going to look something like that. And then if we roll over and we see very aggressive selling, we would come into this place right here, find some very eager buyers, and then we see a nasty bear market bounce back around to this level, and then we break down. And if you've been around the technical analysis world at all, you probably know what this pattern looks like. This is a giant head and shoulders pattern. All right, and so you get everyone bared up, and then what would happen is we would see a failed breakdown right here, and then that would mark the exact bottom of the market, and then we would start a cyclical bull right after that. That is because it is the most hilarious outcome, right? That's probably the one that's gonna hit, in the middle of the summer, right? So that's kind of the more bearish thesis. Obviously, things can just continue to fall apart right here. Maybe the Fed gets entirely too aggressive. Maybe we just see a lot of deleveraging in large cap tech. So of course, anything can happen. But I think the best bet right here, is not straight down, straight up. We will, in my opinion, rapidly diverge from this price very soon. I'm talking in the next 2 days. This is not a sticky price. Either we're going to see a hard response or we're going to start capturing some levels back to the downside. Okay. So the establishment of more of a trading range, a lot more back and forth action, I think, is up on deck. There is one, actually, in options land, there's a lot of screaming contrarian buy signals right now. And, these can be wrong. Things can absolutely get worse, but right now we have the options market leaning a little too much in one direction. And I think that was exacerbated by the options market with respect to January expiration as well. So we did a write-up and we sent it out to our newsletter subscribers. It's a free newsletter. You absolutely should sign up if you're not on it yet. Basically talking about how the introduction of January options expiration would potentially lead to an increase in volatility, and it did. And now that we're on the tail end of it, it's like an options-related release valve that just basically a lot of supply got introduced as there was a lot of option rebalancing with very in-the-money options. If those get exercised, then they sell them in the market, or the market maker needs to drastically reduce their exposure in the very short term. So a lot of things were happening in options land that the tail absolutely wags the dog now because of lower liquidity in equities and more trading in options and derivatives. So that absolutely is a thing. So we've got that combined with way too many people selling calls on higher strikes and thinking, oh, this is going to be good income, and they're selling it for not a good price. And so if we see a bounce, it can self-reinforce through the options mechanics. We've talked about this plenty of times. If you want very extreme examples of it, you can look at GME and AMC back in March of 2021 during their massive moves and those option-related moves as well. It absolutely does affect the indices as well. So we could easily see what we call a gamma squeeze or a Vanna squeeze back to the upside in very short form, which leads me to my next point. There are some very clear short opportunities or places where you could really speculate on some downside. Just like this was an obvious level for bullish positioning, it's also an obvious level for bearish positioning. So if we were to bounce really hard into this and you'd say, okay, that's a great short opportunity, I'm going to short it because, prior resistance and so on, way too many eyeballs, way too many people getting short, and then you get that secondary squeeze. And I think the better setup is going to be the secondary squeeze either into 454 or into this anchored VWAP right here, which could start flattening out and coming in right to that. So I think that the first bounce is going to be a very difficult short. I think the second push is where you're going to get better opportunities, especially if you do want to sell call spreads or some more advanced options setup. Okay. Since we're talking about options, let's just hop over to the VIX really quick. The VIX is trading at 28. It broke to basically 30. If this were 2020, that would be kind of normal, but this is 2022. And our current volatility regime is basically the lows are right around 15, and then the highs are somewhere around here and probably a little bit lower relative to what we've seen here because liquidity has improved a little bit in the system. We're seeing volatility as a whole just continue to cool off a little bit. It definitely did pick up as we did see a shift in Federal Reserve policy. But I think that the range for the VIX continues to be needs to be clamped down unless we really see actual volatility in the market significantly pick up. So this is a level that I would construe as saying, a lot of folks are getting hedged, a lot of folks are getting bared up, and placing not just index options exposure, but also in those large cap tech kinds of stocks that absolutely do bleed back into the S&P due to volatility arbitrage and a bunch of weird things. So this is the start of what I would consider a fear signal, a capitulatory signal. Two things can happen here, and it's very similar to what I just said about prices not being sticky, right? The S&P is probably not going to trade at this current price for a while. We're either going to have a really hard bounce or we're going to have a hard sell-off, but we're not going to create some sort of bear flag or range. A very similar thing happens when we do get a VIX that has seen a strong spike where either things get a lot worse or we get a very aggressive bounce. All right, and we're seeing something very similar in VIVIX, and this is the This measures the demand for VIX options instead of S&P options. And we're at pretty elevated levels here as well. This did go all the way up to 210 during the March 2020 crash. But prior to that, our trading range for this was 80 to 105, and then maybe, 110 to 85. And now we have this new higher level because a lot more funds are using VIX options and futures as a way to protect themselves. And so there's just this new structural demand. But 145 to 150 tends to be a level where, go line up these spikes in the VIX, and they have tended to be very good bottoming plays in the market where you do finally signal a lot of capitulation. One more thing, we did have the VIX futures market go backward on Thursday and Friday. So that either here or there, right? Either we get a capitulatory bounce or it starts to signal that things are getting really off the rails. Okay, I know we talked a lot about a lot of things, so we'll just go to the other indexes very quickly. The first up is the Nasdaq. I'm not surprised that it did get hit. The generals were the last to get shot. So, this what we would consider a short-term bear market, it did not start 2 weeks ago, right? We have seen the continued bludgeoning to death of any high-growth stock, anything with a high sales multiple, anything in the software space, anything in the tech space that wasn't Apple, have just been bludgeoned to death. Like you can look at something like, you can look at SE, right? 340 down to 160. You can look at Cloudflare, which is NET. That's 210 all the way down to 94, right? I haven't looked at Fastly in a while, but yeah, those kinds of charts are all over the place where it's been a bludgeoning for months for a lot of these things. And we have seen it reflected if you look at IWM, which we'll get to in a second, a full year of distribution before this breakdown. Right. So finally, Apple, Amazon, Facebook, Google, Tesla, they all got nailed. Right. They finally saw some proper selling. This could be related to some of those option mechanics into Jan OPEX. All right. So just keep that in mind. Right. But we finally did see some selling acceleration and what I would consider close to a capitulatory move in the Nasdaq in the very short term. So one thing I got absolutely wrong last week was that we have this high volume range where I thought that, okay, there was a lot of trade facilitation that happened, during this trading period right here. So odds are we'd find some, slowing down, at least a supply of liquidity. And nope, we just knifed right through it, right? It took 3 days to get through that. So we're close to we've got this, it's not a low volume node, it's just this giant low volume range where normally we'll see price responses into an LVN, but when we have something this wide, I'm not entirely sure how we can play this. We've got basically a volume shelf right here and a volume shelf right here. So either we're right at this brink level with this support level and this volume weighted average price against this, and then we find a bounce, maybe coupled with some of those option related mechanics, those shenanigans that are going on, or we come and grab this level, which corresponds with the AVWAP from the September lows instead of, that's looking kind of vulgar, we're going to take that off. So yeah, I am positioned for a very aggressive bounce over the next 2 to 3 days, and that is by way of some pretty advanced option stuff with some callback spreads and some things like that where I'm sized where if we completely get crushed to the downside, my risk is very little. I actually lose more if we go sideways. And that's one of the reasons I keep talking about this kind of idea where prices aren't sticky. So for me, yes, I would absolutely prefer a pretty hard retracement back up to some of these levels. So these levels did hold for a pretty good amount of time, meaning like 90 minutes. So if you look at our levels, we had this support level come in, the anchored VWAP came into play and held at this resistance level. So that was the best swing short opportunity. If you do want to journal that, that's a really good setup. We came back in and there was a lot of congestion right here. And this is a big deal, right? If you see a hard sell-off, right, into a level and you don't see if you don't see massive price response to the upside, instead, if it just starts chopping around, that means these prices are being accepted and you have higher odds of seeing a breakdown. Okay, so that's something to watch for. And that is where, if this market wanted to find hard buyers, I think maybe not the first touch of this level, but the gap down right here. Run some stops, you get this push, you make a higher low, and then you're off to the races, but you don't see that structure. You just see continued rollovers every time we were coming back into the upper end of this range. So yeah, we did see a swift move to the downside. We did see some very fast price response against this level for about 90 minutes, and then the whole thing fell apart. The way the market traded on Friday at the close, there was some weird stuff going on. Again, I think it was some option voodoo. So we'll see over the next few days. So we've got this level right here, that volume shelf. We have this brink levels volume shelf that we've got coming into play. And then we've got the upper end of this trading range right here, which is going to correspond with that volume weighted average price right there. So that would be a pretty good short level if we were to get it. Again, just like what I talked about with the S&P, you may have something where it rolls over a tiny bit and then we see a stop run, maybe to this LVN right here, which would be that's a pretty good level. I don't have it drawn on here, but if we look right here, okay, price response here and here and here and here. So we may see something, right, where we get this move higher and then it looks like we're going to roll over again. Everyone gets bared up, right? And then you get that stop run. And this becomes a much more attractive short candidate or a place to buy puts than it does with, that first level. Again, very similar model. How would this play out to frustrate the most people, right? We would do something stupid like this, maybe trade a little bit lower, and then we start to roll over and everyone would start screaming, oh, look, it's a head and shoulders pattern. You know what would happen? We would break to this level, find buyers, and that would be it, right? So watch for that. When the breakdown becomes so obvious, look for the levels just below. And if you start to see signs of a failed breakdown, that tends to be a very good place to play. I know this because I tried to play the head and shoulders top back in the summer of 2009 on the S&P, and that was a great long opportunity instead. So keep all of that in mind. The biggest risk continues to be in small caps simply because we have a full year's worth of distribution. So this is the IWM. We saw we just saw this level get hit like 12 times, this key support level, and it finally rolled over. So we get this bounce, come to the anchored volume weighted average price right here, and then we see a stop run into another key level where we've seen previous price response, and then the whole thing gets truck stick to the downside, right? Now what happens here? What did we just talk about? Price acceptance, right? Well, we have this sell-off, and then we put in this hammer candlestick into the support level with the anchored VWAP from wherever it was. And then we come into here and price just doesn't see any move, any follow through right there. And then we come back at this level after we've touched it just 4 days ago, and that's when you get the rollover. So in terms of levels on the Russell, it's tough because we did not see a whole lot of trade during this rally. It saw a gap up on the election, Nov 2020, and then it just basically went straight up. So we do have the VWAP from the March 2020 crash lows going to be coming into play along with the local LVN right there. There's also some other stuff coming into play, right around 186 and then 179, but it's just not enough information to really say anything other than, oh, here is the big prior resistance level. Maybe we'll just come back and test that to really scare everyone. So that's ambitious, especially over the course of a full year. What's that for the Russell? That's a 30% pullback. That's a full-blown bear market, right? So the question is, how long is it going to take for the Russell to correct 30%? Just as an example, we saw, what was our crash right here? This was the fastest crash of all time. That was 40%, and it took, something like 3 weeks. All right. So if you're expecting this market to trade like the COVID crash, I guess it's possible, but in terms of odds, how are you willing to express that bet, and how much are you willing to bet that that's going to happen? It's a difficult bet to make. So the next thing here, very obvious, capped and obvious prior support levels coming into play. If we were to bounce into this, I would be really impressed if it were the local top. Very similar to what we just talked about. You know, the obvious short level is probably not going to be the easiest short level. You want to look for that first stop run, and then you can start looking at buying some puts. Okay, that is our index analysis. Thank you so much for watching. For those that are PVA members, you will be getting our portfolio review. If you aren't a PVA member, make sure to join up. That's all I got for today. Take care, everyone.